Tax fraud refers to the intentional act of misleading or concealing information on a tax return in order to avoid paying the correct amount of taxes owed. While most taxpayers are honest and file their tax returns accurately and on time, there are a few ways that taxpayers can accidentally commit tax fraud. Here are 5 possible scenarios. 1. Inadvertently underreporting income. One of the most common ways taxpayers can accidentally commit tax fraud is by inadvertently underreporting their income on their tax return. This can happen if the taxpayer forgets to include income from a side job, interest or dividend income, or income from freelance work, among other sources. While the error may be unintentional, it can still result in a penalty if the taxpayer is audited and found to have underreported income. 2. Ignoring tax deduction limits. Taxpayers can also accidentally commit tax fraud by claiming tax deductions that exceed the limits set by the IRS. For example, claiming deductions for business expenses that are not actually business-related, or claiming charitable contributions that are higher than the actual amount donated, can result in a penalty if the taxpayer is audited and found to have overclaimed deductions. 3. Failing to report foreign income. Taxpayers who have foreign bank accounts or investments may accidentally commit tax fraud by failing to report the income generated by those accounts or investments on their tax return. Failure to report foreign income can result in hefty penalties, even if the error was unintentional. 4. Filing false tax credits. Taxpayers may also accidentally commit tax fraud by filing false tax credits. For example, claiming tax credits for dependents who are not actually dependents, or claiming credits for expenses that were not actually incurred, can result in penalties if the taxpayer is audited and found to have filed a false tax credit. 5. Failing to file tax returns. Finally, taxpayers can accidentally commit tax fraud by failing to file their tax returns on time. While this may not seem like a big deal, failing to file a tax return can result in a penalty, even if the taxpayer is due a refund. Additionally, failing to file a tax return can raise a red flag with the IRS, which may increase the likelihood of an audit. It is important to note that even accidental tax fraud can result in penalties, fines, or even jail time, depending on the severity of the infraction. It is always best to consult with a tax professional or the IRS directly to ensure that your tax returns are filed accurately and on time.